What's happening, guys? So today on this video we're going to be going over market structure shifts and what makes a valid market structure shift, and also what makes an invalid market structure shift, and how to actually navigate and understand which ones are correct in order to trade from these market structure shifts. We're going to be going over what is a fake out in relation to a market structure shift, and this actually means that it's not a proper valid market structure shift, whereas an actual market structure shift you'll be able to tell the difference. So a market structure shift is when price breaks through a short-term low or a high, or a swing high or a swing low. So as you can see here in this, price is displaced lower and closed below this short-term low or swing low, and it's key that we actually see a full body candle close below the low, not just a wick, like leaving a wick here for example. These are wicks. We want a full body close below, and what you tend to find within this is a fair value gap, as there's a lot of volume in the market to push through and break past this low and close below. It's also crucial that we get market structure shifts on both pairs MNQ and ES, as we want to be aligned in price and actually make sure that both pairs are wanting to go in the direction that you're intending to go. So now that you've seen it on what it looks like here, I'm now going to show you on the actual charts on a trade that I took. So here you can see a market structure shift. You could say there was a market structure shift here, but the reason why I ignored this one is because there's no fair value gap there, which indicates to me that price is not yet intending to actually go lower yet. There's no actual volume here, whereas here we can see an actual fair value gap, and then we actually get a full body candle close. See, on this instance here, we didn't get a full body candle close until this candle closed. We didn't get a body candle close until we closed below this low. So we would use this as the actual valid market structure shift, paired with a fair value gap, which is where I got the entry as soon as it tapped back into that fair value gap. So this is a valid market structure shift because we've actually got a body candle close below, and it's got a fair value gap. Now, say for example we were wanting to go long instead of short here, and what you can see is that we've swept this low, so we've hunted liquidity, and then we start pushing up, and then we pull back, and then we push up again, but we haven't actually closed above here. What you see here is a wick, so we've actually grabbed liquidity here. It's not a valid market structure shift to go higher, plus there's no fair value gap either. This is what catches a lot of traders out, because they anticipate price is going to close up here, but it actually doesn't. So then they eventually get stopped out, because if they ever stop here and they anticipate price is going to close here above this high, and then price eventually comes back down to actually stop them out. So this is not a valid market structure shift. And also we don't anticipate what price is going to do. We don't guess that this is going to close here. We actually need price to show us that it's going to close, like it does here on this one. It actually shows us that it's closed below the low. Another example within this price range of a liquidity grab and not an actual market structure shift would be here. We didn't close below this low. This candle did not close below here, so it's invalid, and it didn't actually sweep any liquidity, it just came back up. So people who are anticipating shorts here for this candle to close and have the stop here would have been eventually stopped out by price, because they're anticipating it's going to close down here. We don't anticipate what price is going to do, we just wait to see what it does and shows us what it's going to do. I'm actually going to break this trade down and show you why we look for market structure shifts like this using a higher time frame bias with the fair value gaps, which we use to determine bias. So coming onto the 4 hour, we tapped into this 4 hour bearish fair value gap. So on the 4 hour we're bearish. The daily also tapped into this daily fair value gap. The 1 hour also tapped into the same area, 1 hour fair value gap. So that's 3 time frames already that we are bearish on. So we'll look at the 15 minute, and again swept into a 15 minute fair value gap. So once we've got all our time frames aligned and we've determined a bias that we are bearish, then that's when we start looking for the actual entries. Now this trade happened at 10:45 or 10:46 this happened, so this is literally the start of the second macro. So this is a valid trade because we were in macro time. So once we know what our bias is, we're then just waiting for the actual displacement lower and a market structure shift, which is valid, to get an entry. At 10:43 we actually got the market structure shift, leaving the fair value gap, and then this is when we got the entry at 10:46. So here's another trade that I took as well. This is a valid market structure shift because we've displaced lower than this swing low, closing below, and also leaving behind a fair value gap, which is of course when it tapped back in I got my entry to go short. So stop would have been here. You can see we've actually got a full body candle close below this low here. Now what we haven't got on here, but we did have on ES, was an actual mitigation block that we broke past. So if we've got a mitigation or a breaker block on either, we can take this trade still, as long as we both get displacement and a market structure shift on both with a fair value gap on both, then we can take that. Now the reason my stop was here is because it's above where the mitigation block was on ES, so this is a valid trade, and targeting a 1 to 2 or the nearest low what offers a 1 to 2, which in this case was 1 to 2.16. It's a very telltale sign that once you actually get that market structure shift, that price will start delivering lower if you have the bias aligned. So on this trade again, I'll run you through the actual bias. So the 15 minute tapped into this 15 minute bearish gap, the 1 hour tapped into this bearish gap, and then the 5 minute also tapped into a 5 minute bearish gap, but we was trading into a bullish gap, but that just makes the setup more of a B plus than an A plus. So that's 3 out of 5 time frames aligned. Also on the 4 hour, we had previously tapped into this bearish gap and we was bearish up until the next low or bullish fair value gap, but there isn't any bullish fair value gaps, so we're bearish up to this low. That's actually 4 out of 5 time frames aligned bearish. And on the 1 minute you start looking for the actual market structure shift and displacement lower, like here with the fair value gap, and paired with a mitigation or a breaker block, which in this case the mitigation block was on ES. This here, for example, is not a valid market structure shift. As you can see, we've not displaced lower than this low here, so this is not a valid market structure shift. This is more of a liquidity grab again, and this would have been into the 5 minute. See, it's actually tapped back into that bullish gap. Then it's started accumulating, and then it's manipulated these highs into this fair value gap, and then it started its displacement lower, and then you get the market structure shift here. So this is again not valid. We've not got a body candle close below this low. Hopefully that makes your understanding on market structure shifts a lot better. We want to see a body candle close below the low, short term low or a swing low like this, paired with a fair value gap like this for an instance. And also for our model we want to see a mitigation block or a breaker block paired with the fair value gap and the market structure shift. Thanks for watching, guys.